All right, let's dive right into this explainer. We're going to uncover exactly how retail traders get consistently trapped by market makers. And more importantly, we'll look at the new decentralized infrastructure that's actively trying to level the playing field. If you've ever felt like the market is literally trading against you, you are definitely in the right place.
Look, we've all been there, right? You carefully set your stop loss, the price violently wicks down just to take you out, and then it immediately reverses right back in the direction you originally predicted. It's incredibly frustrating. But hey, it's not bad luck. In these hyper-volatile crypto markets, where a 20% swing is just a normal Tuesday, market makers, whether that's centralized exchanges, massive whales, or algorithmic firms, they don't just facilitate trades, they actively shape price action to trap retail liquidity. Basically, you are the liquidity. But today, we're going to figure out how to stop being the prey. Here's our roadmap for today. First, the market maker traps. 2, decentralized trading infrastructure. 3, the INJ supply squeeze. 4, catalysts and institutional interest. And finally, number 5, future price predictions. Let's get right into it. Section 1, the market maker traps. Let's look at exactly how centralized exchanges in whales manipulate price action to grab your liquidity. So according to data from AllTradey, there are 5 clever liquidity grabs happening every single day. First up, fake breakouts. That's where they push the price above a resistance line just to bait retail into buying, and then they dump it. Second, stop hunts. This means spiking the price into specific areas where they know retail traders have clustered their stop losses. Third, range traps, basically chopping you up in tight, sideways action before a fake move. Fourth, inducement moves. They slowly creep the price up to a key level to lure in weak hands, and then boom, a fast reversal. And lastly, news manipulation. You know the drill, pumping a token the second news drops, only to dump their bags on the retail traders rushing in 15 minutes later. But you don't have to just sit there and take it. You can actually outsmart these traps. By using indicators like the volume-weighted average price, or VWAP, and on-balance volume, you can confirm if a breakout has actual real volume behind it, or if it's just whales spoofing the market. A good rule of thumb, avoid trading too far from that VWAP line. Also, use the average true range to set strict, intelligent stop losses that won't get easily hunted. And always track on-chain data to see where the whales are actually moving their funds. Oh, and definitely test these strategies out with paper trading first before risking real capital. Moving on to Section 2, decentralized trading infrastructure. If centralized entities are manipulating the order books, the logical solution is decentralizing the infrastructure through sector-specific Layer 1 blockchains. Now, for years, trading on Ethereum meant using automated market makers, or AMMs. That was mostly because the network was just too slow and expensive for anything else. But networks like Injective, they are bringing the traditional stock market model, central limit order books, fully on-chain. By moving the actual matching engine directly onto the blockchain, they use frequent batch auctions to provide MEV protection, which means miners and bots simply can't front-run your trades. It effectively brings the speed of a centralized exchange into a totally non-custodial, decentralized environment. It's a massive shift. So for talking about blockchains built exclusively for trading, we really have to compare the two heavyweights here, Injective and Sei. Injective operates with roughly 0.8-second finality and leans heavily into the institutional side. It offers robust, native primitives for derivatives, perpetuals, and shared liquidity across all its apps. Sei, on the other hand, uses parallelized processing to hit a lightning-fast 0.38-second finality. That makes it super attractive for high-frequency retail traders and general DeFi degens. Both are effectively ending the era of Ethereum bottlenecks, but they're targeting slightly different trading crowds. Section 3, the INJ's supply squeeze. Because let's face it, a great tech infrastructure is nothing without the economic anchor holding it together. Let's dig into their tokenomics. 100%. The Injective community recently passed IIP 617, an upgrade famously known as the supply squeeze. And this massive governance upgrade permanently increases the token's rate of supply reduction by exactly 100%. Basically, they're doubling the network's deflation rate, actively engineering INJ to be one of the absolute most deflationary assets in the entire crypto space. And this structural scarcity, it didn't just happen overnight. Following the timeline, Injective started burning tokens way back in December 2021. Then, in August 2023, they launched INJ 2.0, which allowed all decentralized apps, not just exchanges, to contribute fees directly to the burn. Come October 2024, they initiated a massive community buyback event to systematically remove tokens. And now, early 2026, the supply squeeze acts as this massive accelerator.
By combining reduced issuance with recurring on-chain burns, they're creating profound compounding scarcity. Section 4. Catalysts and institutional interest. Okay, great tokenomics are fantastic, but you need actual demand. Let's see what's driving this network's momentum forward in 2026. So, major TradFi-level catalysts are seriously lining up right now. First, Canary Capital officially filed for a staked INJ ETF. That's incredibly unique because it proposes a yield-generating structure right out of the gate. On top of that, Injective joined the ranks of Bitcoin and Ethereum by getting listed on the regulated U.S. futures market under the CFTC. On the technical side, INJ USD is now the official default standard stablecoin for the Cosmos Hub and DYDX. Plus, their whole infrastructure is purpose-built to capture the massive incoming wave of real-world asset or RWA tokenization. When you look at the real-time market data resulting from all these catalysts, things get wild. In mid-May 2026, INJ broke out of a multi-month falling wedge, and this wasn't a fake breakout. Open interest climbed a staggering 60% with massive volume. But here is the kicker. Funding rates were negative. That means the majority of the market was betting against it, actively shorting the asset. So as the price climbed, those short positions were forcefully closed. They had to buy the asset back, which acted like a loaded spring that shot the price up 48% in a single week. All right, final section number 5. Future price predictions. Let's objectively evaluate the micro-level price predictions extracted from the data to see where this is all heading. In these data-driven forecasts, you can clearly see the exact market assumptions required for each scenario. In the bear case, sitting between $3 and $6, DeFi basically stays muted, and Injective is trapped in range-bound survival mode. The base case, projecting $12 to $20, assumes a solid recovery in DeFi volumes and a rotation back to on-chain perpetuals, so essentially a 2x to 4x from current levels. But then there's the bull case, targeting $35 to $60. That scenario entirely hinges on explosive institutional adoption, massive RWA acceleration, and absolutely crucial here, a favorable passage of the Crypto Clarity Act. Now, it's absolutely vital to remember these are just market forecasts. Injective doesn't operate in a vacuum. The network faces severe roadblocks. For one, there's fierce competition from incredibly fast Solana-based derivatives. Plus, regulatory uncertainty regarding the Clarity Act still hangs over the entire industry. Liquidity is highly fragmented across dozens of Layer 1 and Layer 2 chains. And perhaps the biggest hurdle, narrative risk. We all know the crypto market often ignores brilliant functional technology in favor of whatever meme coin happens to be trending that week. If Injective can't market its tech, it really won't matter how good it is. Which brings us to our final thought. The technology to prevent retail manipulation, it's clearly here. The deflationary tokenomics are locked in, institutional products like ETFs and CFTC futures are actively being filed. But ultimately, does the broader market actually care about fundamentally sound financial blockchains anymore? Is this a deeply discounted financial infrastructure bet, or just a forgotten Layer 1 value trap in a market totally obsessed with hype? Well, that's the question you need to answer for your own portfolio. Thanks for joining me on this explainer. Stay sharp out there, and remember, never be the liquidity.